Hi, welcome to this episode of Insurance VC, PE, and M&A. And today we have Kelly Drouillard. Did I get that right?
Yes, yes.
Okay, Kelly is an awesome person I know for a while now. Probably what, 5 years since I know you?
Yeah.
And she's an industry icon, a long time with Live Oak. And now that she have her own consulting practice, so I invited her on the show. I was like, you know what? She's seen hundreds and thousands of deals probably in her lifetime in the insurance market, insurance space. So I'd love for you to educate us today on transactions, MA, and you know, and also you can give us a lot of perspective on the lending side. So I'm excited about this episode.
Great. Thank you.
I'm gonna turn the mic over to you, and if you can, just do a little introduction with our audience.
Okay, fantastic. So, first of all, I love the insurance industry. I started in insurance right out of college with KPMG. I'm actually a CPA by trade. And my first engagement was on a long-term disability claims TPA for Pan American Airlines. So most of you guys are too young to remember Pan Am Airlines. So that's good for me because I have well over 30 years of insurance experience. And about the first half of my career was on the carrier and the reinsurance side. And the second half of my career has been in the deal world. And I do all types of insurance services and distribution, including agency M&A. I recently did a medical management company for workers' comp catastrophic claims, which I have a very broad base of knowledge in insurance, and I love it. And I spent many years on the capital side, raising debt and equity. I've been a banker. I have been the deal maker and advisor, which is a role that I love as well. And just a lot of consulting, perpetuation. When is the right time to sell? I get a lot of questions from agency owners, especially in the recent couple of years, because multiples are so high and they almost feel like, geez, maybe I should sell. But that's not always the right answer. And you really need somebody to help think it through. And I just do a lot of that, a lot of just helping owners think it through and what the right strategy is for where they are in their ownership life cycle. And I talk a lot about ownership life cycle because I think as an owner, to me, there's kind of three stages. There's the grow and build stage where you are doing everything to grow your agency. Maybe you're working with somebody like Jeff, whatever it is, that the most important thing for you is to grow your agency. And you need to be responsible regarding cash flow during that phase. But we all understand that you have to invest in your agency in that era of building and growing. And then you get to the middle stage of ownership, which is where I think you've reached a certain scale, you've got enough size that there's some meat on the bone. And then you think about fine-tuning your strategies and optimizing your agency performance. So you're still adding and growing, but you should start to have some nice profits and some consistent operating results. And that's important in those years where you are fine-tuning and optimizing your agency. You're definitely still growing, but the financial results become a little more repeatable and sustainable. So you can really make some strategic decisions with the idea that you've got good cash flow to work with. you're making a nice living, and you still got plenty of gas in the tank to grow, and your energy level's high. And then this last phase, that third phase, I think, in agency ownership is where you really got to plan for perpetuation. How does the movie end? And during that phase, you want to optimize your EBITDA. You want to optimize your profits. Absolutely, you need to invest in the agency, but you need to be mindful that that investment is going to have, let's call it a return on equity or a return on investment within, 12 months or 24 months at the outside, because your ownership years are numbered. You're planning on perpetuating. So when we look at the agency life cycle, I have clients at all stages. I have in the build and grow, I have in the optimize stage, and I have in the perpetuation phase. So it's just, I enjoy all parts of the ownership life cycle. So as an owner, be mindful about how to prioritize based on which stage you are in your ownership life cycle. Then you can think about, okay, how does the current M&A environment relate to my agency ownership? And don't feel like you need some urgency to sell just because the multiples are high. Multiples are high. There's endless capital flooding our business, and that is a wonderful thing. But I see two things going on. Sellers are getting younger, but there is also too young to sell. And in my opinion, if you still have a lot of energy and go, and you're really working on your agency, you're addressing problems, because let's face it, every agency has problems, and you're resolving those problems. You're finding solutions with technology, marketing, you're hiring, you're excited. It might be a little too soon to sell. When you start to think, I love the business and I love agency ownership, but I'm tired of solving the same problem for the 5th time in 10 years. Or you're getting a little worn about some of those things. That's when you need to think about selling, because the buyer wants somebody with energy. They want a seller that still has energy to go and grow. And that's how you get those sweet multiples that we talk about. You don't want to wait until you're burned out if you want to optimize your multiple upon exit. So I think there's just been a shift over the last 5 years. Agency owners are more savvy about access to capital and the ability to use debt responsibly. And using debt responsibly is probably one of the most important strategies you can consider. If you have really good ideas and ways to grow your agency, and not dreams and vision, and I'm going to disrupt and I'm going to create this new technology. That's for your venture capital. That's for your equity investor. But if you're an agency owner that has a good track record of getting things done and growing, using debt responsibly to pour on the jet fuel is a great strategy, because it will compound the value exponentially when you finally do sell your agency. whenever that is. But it's always a balance. You've always got to be careful of cash flow. That's why I emphasize use debt responsibly.
So while you were talking, I came up with a list of questions from everything you
Okay,
shared.
great.
I think this would be fun for our audience to, because these are some of the questions probably in their head. And I might be starting out a little basic, a little bit vanilla, but hopefully your knowledge can deep dive us. Okay. So as a person, we talk about stages of an agency career, right? As someone that's in the growth stage, one of the quickest way to grow is acquire, right? Acquisition. And come from your background of lending, can you give us three ways to acquire and grow? Traditional lending from a bank, SBA 7A lending from a bank, and also getting outside investor to come in, give up equity shares of the future company, and bring in outside investors. Those three things I just mentioned, can you kind of give your opinion of the pros and cons of each pros and cons of each every single one?
Let's talk about the two types of bank debt first. So in the world of getting a loan, which I have been very active in for 15 plus years, you have what they call conventional bank financing, which is just get a loan from the bank. And then the alternative to that is SBA financing. And within the SBA, there's a program called 7A, which is probably your typical insurance agency loan. So the difference between the two, a conventional loan is generally a commercial loan that is made to a business. And generally speaking, the terms are going to be your most favorable bank terms. And that means a lower interest rate. But on the flip side, probably a shorter amortization period, meaning maybe a 7-year loan with a 5-year balloon, maybe a 5-year loan with a 3-year balloon. It's something that the bank does day in and day out to commercial customers. And the bank is 100% at risk on that loan. And that's how they view that type of credit. By contrast, an SBA loan is a loan that is guaranteed by the Small Business Administration, generally for 75% of the loan. So the bank is the lender, the bank makes all the credit decisions, but standing behind the bank is the Small Business Administration providing a guarantee, generally up to 75%. And I say generally because there's certain small loans, there's only a 50% guarantee. Some of the real estate, there's a lot of complicated real estate programs out there. But most often, the 7A program, you're going to have a 75% SBA guarantee. Now, with that loan, you're going to have a 10-year amortization and no prepayment penalty. On the other hand, you're going to have to pay the guarantee fee, which can be around 2 to 3%. And it's probably going to be a higher interest rate than you could get on a conventional loan. So if you think of it in the world of insurance, you can think about a preferred market versus a standard or a non-standard market, or maybe even an E&S market.
That's such a simple comparison. It never dotted with me before, but yeah, that's a great comparison.
Yeah. And I've been a licensed agent in every state for both PNC and commercial and E&S. So back in the day, I did sell. So to me, that is the most obvious. Think of it preferred and non-standard, preferred and E&S. And with SBA is kind of more your E&S type of borrower, and your preferred is more your Chubb type of borrower. And they're both great sources of capital. above all, whoever you're going to, you want to work with a bank that understands insurance agencies. And a lot of time is wasted working with banks that don't do insurance agency lending. They have the agency deposits, they have the operating account, they see the commissions. They know that year in and year out, those commissions just keep rolling in, and they get all excited about it. But they get to credit committee, and here's the deal. We know insurance agencies don't have a balance sheet. There's no balance sheet. There's no real estate. There's no inventory. There's no fixed assets, or very minimal. What insurance agencies have is expertise and a ton of intangible assets. So when you're working with a conventional lender, just make sure they really understand the value of insurance agencies. So that's kind of broad strokes. And I work with all types of capital. I work with banks at each end of the spectrum and everything in between. Now let's talk about bringing in outside capital or an investor. And this is where, when you're in the early stages of your agency, maybe you don't have enough positive cash flow, you're not credit worthy, even in the E&S world, you just can't get a loan. And you go to maybe friends and family or industry investors, and you want to raise some equity to bring in the jet fuel. So the way equity can be structured so many different ways. And what I tell my clients is, you want to be able to get it out. You want to be able to buy out that equity and negotiate that upfront. It is not a perfect process, but you need to be okay with something not being perfect, because you're bringing in equity. The worst thing is to have an equity partner that you can't get rid of, that you're squabbling over the valuation. Legal bills are always going to cost more than some formula that maybe is a little bit leaving $1 on the table. Who cares? You'd rather leave $1 on the table than be stuck with an equity partner, end up in litigation, and spend $20 on legal fees. So, get that formula up front, some kind of option to buy out the equity. The other thing that I like in those types of structures, when you need capital, is you bring in an investment partner kind of from a royalty investing perspective, that you're going to pay off that equity investor, you're going to get them out based on a percentage of revenues. I've done a lot of angel investing in my life. And for our types of businesses in insurance, sometimes royalty investing is a great way for your equity partner to get out of your hair, get paid back. And instead of issuing K1 equity, you can have an agreement that they're going to get back 2x, and it's based on a percentage of revenue over a certain amount of time. That's a real simple way for that equity to disappear. And if you're doing the right things, you want to reward your equity partner because they're putting capital at risk. Yet you want to get rid of that equity so it doesn't cause a problem later on. But there's a lot of ways to structure equity. It kind of depends. I'm working on a partner buyout right now. 50% partner buying out a 50% passive investor. They're having a gunfight over valuation. And it's going to get resolved, but it's going to cost a lot of energy. It's a lot of legal bills. And neither one of them are going to be happy with the number at the end of the day. I don't think there's a number either one of them would be happy with anyway. But partnerships tend to run their course. And but it's a tough one. So to the degree that you can put some things in your equity subscription up front, or you call it some kind of preferred stock that has a component that is an automatic buyout, or it's royalty investing, that it really doesn't impact your K1. It's more like subordinated debt. There's lots of different ways to get that money in your business. And in the insurance industry, we're just as creative as any other industry at structuring deals.
I'm gonna keep on going because I have a list of questions I wrote up.
Okay.
At some point, let's just say I am credit worthy. I did not use an outside investor for my equity. I'm gonna go borrow and line credit, right? Line credit is the easy way to borrow. Either I do a HELOC on my own home or I do a business equity line credit. From your lending experience, at what point does bank feel comfortable say, you know what, Jeff, you can loan against your own company. How much revenue do I need to have in the bank to get a comfortable number from the bank? Thank you for watching this video. Now a quick message from our sponsor, MAV.
Thanks, Jeff. I want to let you all in on a secret that top producing agencies don't want you to know about. If you're in P&C insurance, you know firsthand how much you're getting squeezed by your call center. It's becoming less predictable and less economically profitable to scale. But here's the thing. The top producing agencies making over $100 million are not running their leads through a human-based call center. They're running them through an AI expert like MAV to qualify, quote, and hand deliver the highest intent qualified leads to your agents. MAV takes care of the back and forth, having unlimited 24/7 conversations with your leads that are personal and relevant so you can scale to the moon. Ready to ditch your call center and 10x your agency? We're giving the listeners of InsuredTech's $15,000 worth of credit to try MAV. Head to hiremav.com/InsuredTechs to claim this offer.
First of all, a commercial line of credit is generally always the better way to go if your business can qualify.
Let's talk about that strategy, right? There's a lot of guys who are young, who are bullish. They have process, people, system in place, but at the end of the day, they're cap out their capital spend, right? So what do you recommend to those who want to do a commercial line of credit?
Yeah. So for a commercial line of credit, it's going to be not necessarily based on your revenue, but based on positive cash flow. Your agency has to have positive cash flow before you're going to get a commercial line of credit from most any bank. There are some specialty lenders out there that it's more like factoring, and it's a different type of product that is generally pretty expensive. To the degree you get into that territory, use your HELOC first, because that money is just so expensive. You need to have positive cash flow. A rule of thumb is your debt capacity is going to be about 4 times your net positive cash flow. Okay, so that's a general rule of thumb. Now, what does net positive cash flow mean? Net positive cash flow has to have a salary being paid to the owner, because no business owner can survive with never ever taking a salary. That's not a sustainable business. So with
Positive cash flow, is that, can we use EBITDA for that one? Or are we talking about pure profit, triple net, like net?
yeah, profit, pure profit, or EBITDA. The technical term is always going to be EBITDA, and that
Right.
your P&L, your net profit earnings adjusted, so it's before interest, taxes, depreciation, and amortization, EBITDA. So those are non-cash numbers or non-operating numbers you want out of the equation. So your net operating cash flow is the same as EBITDA. Now, in your net operating cash flow, you need to have an allowance in there or an expense for owner's compensation. So it's not enough to have positive cash flow if you're not taking a salary at all. That's the main point there. Now, the workaround to that would be if you have a spouse that is earning, and we start bringing in outside guarantors. But in general, you're not going to get a commercial line of credit unless you have net operating positive cash flow. And generally speaking, your credit capacity is going to be 4 times your net positive operating cash flow. So if you have an agency that's a $500,000 revenue agency, and let's say that your net earnings on that agency are 75,000. Okay. And that 75,000 net profit, net P&L number, that reflects owner's compensation that the owner is taking out, call it $100,000 as their owner's salary. So you got a $500,000 revenue agency, and you have expenses of 425, which is 425,000, which includes your salary of $100,000. So you have net cash flow of $75,000. So you take that 75,000 times 4, you would have credit capacity of 300,000. You can generally lend about 4 times. Now, I say generally because under the SBA structure, and if interest rates can go down a little more here over the next year or two, you can get closer to 6-ish on a 10-year AM. But
You think so? You think we'll get there?
you know, there's so much swirling around right now. We have no idea what's going to happen the next 12 to 18 months with all kinds of things. There's a lot of policy changes that have been contemplated and discussed, and it just, we don't know what's going to happen.
And there's a lot of business coming up for sale. I mean, if you're a buyer, you're going to have choices.
The silver tsunami is real. That is the boomers selling their businesses, and it's the largest transfer of generational wealth ever. And
they say Canada, US, and UK combined together is 86 trillion.
Wow. Wow, I hadn't heard that number. That's amazing.
I literally just saw a stat on that.
Wow.
Like,
yeah. So
but keep in mind that include like all wealth. That include life insurance, transfer, passing down. Like someone did a study on all wealth. So
yeah,
real estate, exactly. Those are expensive too.
Yeah, it's crazy. The numbers are mind-boggling. So, which kind of, let's just flip a little bit to the other side of that equation is what an opportunity.
Yeah.
What an opportunity to buy an insurance agency.
Yeah.
Many of you, well, maybe you've seen my insurance agency acquisition academy. I teach a lot on how to buy insurance agencies.
Can you drop a quick shout out to your own agency?
Well,
just give us a quick glimpse of what you do there.
Absolutely. I love it. It's one of my favorite things. I love helping people buy agencies. Look for agencies with revenue under 500,000. Source your own targets. If you're an individual owner, you need to look for those acquisitions that are under the radar screen of private equity. You need to look under 500,000 of revenue. And there's 15,000 of these. Over half of insurance agencies are under 500,000 of revenue. And you got to source your own targets. My preferred way of sourcing targets is go to a carrier website, pick one, I don't care. It can be a regional or a super regional, like Auto Owners, West Bend, Selective, Penn National. It can be Safeco. Go to the Safeco website. put in your zip code. In any of these carriers, they all have an agency locator function. You put in the zip code and it's going to pop up all the agencies in your area that have a contract with that carrier. That's your lead list. That's your lead list. And then you got to get after it. It's good old fashioned cold call, shoe leather. Now, these just creating your lead list can be painful. So a lot of cut and paste in Excel. I always say, get a screen scrape. I use Scrape Hero, scrapehero.com. Get a screen scrape of your potential target list. And then you have, that's your lead list. And then you just get after it. I've got a client that I've been working with a year in California on their acquisition strategy. And we're closing 2-1-1 that she found that way.
Nice.
Yeah,
Nice.
it works. And one of them's $250,000 of revenue, little Safeco book, beautiful little book of business, kind of in a rural area, which in California, that's a good thing. It's not in the wildfire or the coast.
There seem like there's tsunami, there's like, you know, the West Coast is getting all kind of weather these days, right? Like the bomb cyclone.
It is not changing. It is not changing. You need to, as an agency owner, especially you're in those first 2 phases of ownership, you need to get good at E&S.
Yeah.
If you hate E&S and you really get screwed up with direct bill and you don't have anybody trained and you hate the whole marketing process, too bad. Get over it. You need to develop E&S expertise because these weather patterns, who knows what's going to happen.
Especially if you're in Southeast US, you got to be good at ES with what's changing, what's coming.
Yep.
I want to talk about next question: representation for seller versus for buyers. Are you mostly on the seller side or are you mostly on the buyer side? Who do you work with?
I'm on both. I'm on both, not on the same deal, but I do buy side consulting on a pure consulting basis, but I do not source the target. And then I do sell side. From a revenue perspective, the revenue is bigger from the sell side deals, but I'm one of the few, I think, M&A advisors that will engage on buy side.
That's good to know. And where's your level of expertise? PL, CL, benefits, life insurance, health, Medicare,
Yeah,
like
it's kind of yes and yes and yes and no. I don't, life insurance is just tough because it's you get with life insurance, you quickly get over into more the investment advisory space. And I don't really work in the investment space or RIA. There's other people that are better, but personal lines, commercial lines, employee benefits. I just sold an ACA book of 6,000 lives that was an ACA operator that was divesting of their individual health book to focus strictly on Medicare. So I've done a lot in that universe as well. And then anything insurance services I do claims TPAs.
let's talk about that.
I did some types of program business. I've done a lot of that from way back when I was on the carrier side and the reinsurance side, putting together specialty programs. So I've definitely got a background in that as well. But
Is claim TPA like just like regular insurance agency too, that there's 50% mom and pop style and then there's 50% big boys type of deals, or
it's the
because they're gonna be
same,
coming off a sale too. So
it's the same type of thing that we see as going on in the agency side. There's small claims TPAs that are regional, or maybe they're specialty, like they just do flood or they just do crop, some sort of And there's big buyers. There's the roll-up strategy is alive and well for claims TPAs. There's just a little bit of everything. The insurance industry, just at the broadest sense, is just attracted to human capital and the expert type of services that we provide. And generally speaking, the profit margins are, at a minimum 20%, typically around 30. And, they can definitely be 40 if you've got some secret sauce and some kind of niche. So it's a very attractive industry. The medical management, the medical case management company for catastrophic work comp claims, which is very specialized, a ton of buyers. And that is anything insurance related. We are an economy in the United States that insurance is a critical piece of our economy. It's not going away. The barrier of entry is expertise. So it's not the barrier of entry as you need millions and millions of dollars for equipment or land or, solar panel engineering. It's expertise. And so not anybody can be an expert. It's people driven.
Have you evaluated one of those VA deals, virtual assistants, resource pro type of companies?
I personally have not been involved with a VA deal, but I know it's happening. The margins typically, depending on the location of the VA, there's been some wage compression as our globalization expansion continues. So business process outsourcing, or BPO, that's been around forever. And so BPO companies have found the insurance channel a great way to expand.
Yeah.
But we're just a magnet for capital and opportunity.
All right. So let's just say today I am a seller, and I'm gonna ask the same question again as I am a buyer.
Okay.
Kelly, nice to meet you. I worked 20 years, and now I think I'm ready. I want to completely sell within the next 6 months. And now I'm hiring you, withdraw a contract to be my advisor, right? Who need to be on this team to help us prepare for the sale? We're talking CPAs, we're talking P&L. Do we need to build P&L? Do we need to build balance sheet, pro forma? Let's just say this is a $10 million revenue and we're targeting private equity that want to buy us out. How do we build this team, and what's needed as a seller for my professional representation to surround myself with?
Right. So,
and then that same question go again for the buyer. So
you bet. So from a seller's perspective, and let's say one of the earliest conversations we're going to have is, have you talked to your financial advisor? And do you know how much your retirement funding is dependent on the sale of your agency? And I have that very candid, very personal conversation with my sellers, because a lot of times they haven't. They're just ready to retire for whatever reason. They're, that age, whatever. And if they haven't talked to their financial advisor, I encourage them to do so. We talk in very broad terms of valuations. And I had this exact situation about a year and a half ago. Agency in Detroit, the seller was ready to retire. He was late 60s. Deserved to retire. He was tired. He worked hard, needed that, was ready. He had a big lifestyle. Let's just say that. And it was time to sell his agency. He needed double the value of the agency to fund his retirement. And
that's a big lifestyle.
He had a big lifestyle. He had a big lifestyle. And this is a situation which I see occasionally where the owner, he was taking every penny of profit out of that agency to support this big lifestyle instead of investing in his agency and hiring producers and developing his book of business. So he had some large account concentration, which was a big problem. They were chronically short-staffed. The technology was terribly outdated. His numbers had been declining slowly because he should have sold 10 years ago. So, you know, it was a very difficult discussion with him, that 3 or 4 of those, until he finally understood the value of his agency relative to what he needed to fund his retirement, because he didn't have any other like meaningful assets. It just didn't work. And so he needed to adjust his lifestyle. Boy, that's a tough one. How do you go home and say, honey, guess what? So it's been a work in progress, and also, you know, realize some of the weaknesses in his agency. So you need your financial advisor, because you need a reality check on this positive cash flow that you've been having, you know, $400,000 year in and year out as your owner distribution, compensation distribution from your agency. What happens when that's gone? And is that enough purchase price for you to invest, and your advisor to invest for you to continue leading your life? So you need to have your financial advisor, make sure you're on the same page. Your tax, your CPA. A lot of times what I run into with CPAs is you have a lot of agency owners have a really good bookkeeper, and they have a CPA that prepares their taxes every year, but they're not business acquisition, or they haven't been through the sale of their business before.
This is critical because I would say 85% insurance agent I've talked to over the past, they tell me they hate their CPAs. Where there's
it's critical, because there are some tricky elements to your transaction when you're selling an agency and how this impacts your taxes. And believe me,
do you have anybody you recommend?
I want to minimize taxes for everybody, but minimizing taxes, there's only so much you can do. You have to pay taxes.
Yeah.
And there's some things you can do ahead of time to make that process less mystifying. And absolutely have to have an attorney that specializes in insurance agency M&A.
Do you have a Rolodex of
Oh yeah,
Avengers you call up? And
I've got really good attorneys. In fact, I was on a call with a buyer previously today, and the buyer is going to contribute some money to the seller's legal fees if the seller uses an experienced insurance agency attorney. First I'd heard of that. Genius.
Why is that important?
I
agree with that, but why is that important from your thought?
You get an attorney that doesn't understand insurance and doesn't understand intangible assets and the goodwill allocation, purchase price allocation, the terms of reps and warranties, tail coverage for E&O. You burn so much time and money and energy with an attorney that doesn't understand insurance agency M&A, and it is a miserable experience.
Yeah.
So definitely you got to have an attorney that understands insurance agency M&A. You have to have a CPA that understands business M&A, and you need a financial advisor that understands you personally and your financial situation to make sure that your wealth and retirement planning, all those things sync up. Otherwise, it's a really miserable experience. You know, and you don't want surprises. That's one thing. Experts will help you. There's no reason to think that a business owner would understand all the ins and outs of selling their business or selling their insurance agency. You haven't done it before. How would you know? Get experts. Get experts. And that's you know, we have that conversation pretty early when we're working with our clients and selling their agency.
The part, which is something that, out of all the things you said, I was like, so many people forget about
Yep.
Okay, so I have a couple more. If your time's
You
good,
bet.
I want to ask a couple more.
Bet.
A lot of people, when they sell their agency, they think this is it. But as a buyer, I don't want to buy an asset and next, watch this asset just bleed away with retention out. I want to put incentive in place for the seller to stay on a little bit. What are the typical non-compete time frame that you used to see? Earn out time frame that you used to see? And then the earn out multiple that you are used to seeing. Thank you for all your support to our channel. Here is a quick word from our sponsor. Please click on the link below in the comment section to sign up for a demo with Track AI.
What if your insurance sales conversations could work harder for you? Meet Track, your AI-powered conversation intelligence partner. Track automatically captures and analyzes every customer interaction, providing instant call summaries, risk analysis, and AI-driven coaching insights. Say goodbye to manual note-taking and hello to more selling time. Track handles the admin work while you handle the revenue. Fully integrated with your favorite platforms. Plus, get custom AI analysis tailored to your unique business needs. Transform your sales team's performance with Track. Visit track.ai today.
Click the link in the description below to schedule a demo with Track today.
The first question was non-compete.
Non-compete.
Yeah. That is very geographically specific. It's different. Some states have some really stringent requirements or laws around that. Most typically, it depends on the age of the seller, but I see like 5 years is not uncommon, 3, but there's sort of a lifetime of non-solicit.
Yeah.
So you can't sell something with the idea you're going to go back and try to get that client back in 4 or 5 years. You're just
That's bad faith.
Yeah. So there's other ways you're going to violate certain items of that agreement, but it's
I
really,
think non-solicit is way more important than non-compete. I mean, if someone want to go back and sell insurance, I don't care. They don't come back, poach their employees or their customers. I don't care. I don't care at all.
yeah. You're just, if you sold it, it's gone.
Yeah.
The earnouts generally 3 to 5 years.
Usually 5?
Oh yeah.
Wow.
Oh yeah. Well, there's some pretty good multiples out there. So
Yeah.
if you're getting, if you're a seller that's 55 and still has, a lot of energy and loves insurance, but you're sick of HR and you're sick of technology. First of all, 5 years goes really fast. And that's very reasonable for the type of compensation you're getting in terms of purchase price. So
Yeah.
sellers are younger because earnouts are longer. That's a part of it. And then these big multiples that you're seeing, those are more weighted to there's a lot of juice in some of those earnouts or the stock, the equity component of the deal. So
Yeah.
it's worth your time. What was your last question on that?
So actually, I want to stay on that earnout question. Capped versus uncapped.
What's that again?
Capped earnout versus uncapped earnout. So supposedly, I hear like, oh, all these private equities, they've been burned by uncapped earnout because agents just leveraging it and pushing all the fuel in, jet fuel in, and really crushing their earnouts. But to me, I'm like, why would I want to cap someone's earnout when they are driving in business cheaper than I can buy it on the streets?
I haven't seen a cap.
I talked to a couple private guys, and they've been telling me
Yeah,
they're
what
capping
I
earnout. So
what
I was like,
I
it doesn't make sense to
what I
me.
have seen is a PIF provision, like policies in force,
Mhm.
because rates going up 15% doesn't mean you are earning anything. You know, now, most you're gonna
Oh, you talk about basically there are people who
policies
wrote
in
it
force. I mean, I
zero,
want real
but
growth.
rate increases
Real growth.
got them massive earnouts.
Yeah, I want real growth, not just
That makes
not
sense.
just
That makes a lot of
expiring
sense.
was 10,000 and renewing was 15. That's not growth.
Yeah, yeah.
Yeah, now that works through the numbers for sure, but so
Hmm.
there's the one that when we talk about earnouts, there's multiple components to the earnout. Many of them are based on a minimum EBITDA,
Mhm.
which is well and good, except you don't own the business. Are you going to have a corporate overhead allocation? Or what happens if you want to hire a producer? Does that impact your EBITDA margin, even though it's the right thing to do for your business? So you got to be careful about how those definitions are in the earnout.
Yeah.
An earnout that is strictly based on revenue, lots more straightforward. But there's still, you want to peel the onion, because what if the buyer, what if you are placing business with a carrier that's paying 12% and the buyer's contract is 15%? Does that 3% lift go in your earnout calculation as an increase in?
Such a small detail make big difference.
Big difference, especially with some of these big buyers. If it can roll to a special program or an
Yeah.
in-house, facility. So you need to, the bottom line is work with an advisor that's going to help you because
Yeah.
you don't know what you don't know. And
What are the common multiple you're used to seeing on earnouts?
first of all, it varies by size a lot. It really does vary by size, and it depends on the carriers and the regions. So
So true.
the most important thing is people like to talk about an all-in multiple, which is cash at close, maximum earnout, and the equity. If you're working with a PE buyer, you're going to take equity in the buyer, and they have tricky math and fancy spreadsheets that show you your equity is going to appreciate 4 times, and you're going to make more on your equity than you did on your deal. And you just got to really look at these things. So when you talk about a multiple that's fully loaded of 12 or more, and they're getting up there, but it depends on the size. Okay. Like if you get over $1 million of revenue, and every $1 million increment, there's sort of another stair step in multiples. So $1 million of revenue, 2 million, 6 million, whatever, whatever that increment is, they vary a lot. I would say for under $1 million of revenue, depending on the region and depending on the buyer, 7, 9. Sometimes it's
Yeah.
if you have a really transient book of business or something that's takes a lot of servicing, like
When you say transient, are you referring just to PL books?
the PL multiples are not as high as the commercial multiples.
Right, right.
Yeah, they're just not. There's still a healthy market. There's still far more than they've ever been. but it's not as hectic or as hot as the commercial lines market. But your EBITDA margin, if you have a nice agency that has a 15% EBITDA margin, and you have a nice agency that's a 30% EBITDA margin, you're going to get a higher multiple on the 30% EBITDA margin. It just, you're doing something right. If you have a combined annual growth rate over 10%, and we're talking good growth in policies in force, good growth in customers, not just top line revenue. So we really position our sellers to preempt all those questions that a buyer has so they can see the true qualities of the agency. We have a growth questionnaire about how established is your growth culture. It's not uncommon to see an agency that has incredible retention, but maybe not a lot of growth. So, and I want everybody to get top shelf value. But not everybody's worth top shelf value. That doesn't mean it's not going to be a great multiple, because it will be, because the environment today is just that good. But it can vary.
So let's just say the other side, the buyer is private equity, and the seller is really getting up there in age, and the seller's like, oh, okay, I just want to sell this agency, and the private equity guys are like, okay, you got to put somebody in place to run your agency, and that's part of the deal, right?
Well, that's why you need to sell before you think you're walking out the door.
Yeah. So in that scenario, what are the things people look for in terms of the next agency owner who's left in charge of running that agency and grow?
Well, an experienced track record. Your bench strength is incredibly important when you're selling.
Let's talk about that bench strength.
Yeah. So your bench strength is, I'm going to talk about best case scenario, and there's not very many of them, but bench strength is on your commercial lines book that you are 2 to 3 deep on every relationship. That means, the producer, the account executive, maybe a junior producer that's been shadowing. Ideally, if you have a really good commercial lines book, a great strategy is to be 2 to 3 deep on every relationship. So that practice needs to be in place for years, not just 6 months before you're selling. So the longer you have that practice, if you're able to illustrate employee tenure, how long that individual has been with the agency, that's great. And then if you can illustrate, they came in as a CSR and then they progressed with levels of responsibility, or they grew into a producer role, and really talk about how the agency developed that employee to develop that bench strength. That's important. The ongoing commitment to education, whether it's CIC or different designations, involvement in trade associations is good, like, a state. Sometimes networks, that can help, because networks can bring resources and training to the table for the staff people in the agency. So bench strength is important. If every person is ready to retire when the owner sells and walks out the door, that's a problem. It doesn't kill the deal, but it's going to impact your valuation. We see that.
Actually, if the agency, everyone's at the retirement age, that could be a scary thought as a buyer. I just thought about that. That's good. That's a good.
Yeah, because the other thing that goes along with that, Jeff, is the clients are the same age.
Ooh, yeah.
Have, if there's not been a lot of fresh blood in the business.
Yeah.
It depends. It depends on the agency. When you have a story that talks about how you market to Gen 2 of your clients,
Mhm.
you know, if you've had the parents insurance for 30, 40 years, and now you have the kids, they just bought their first home, or different, ways that if, especially in a community, like a small town or a very local kind of market, that's important. The involvement for that type of agency, involvement in local activities, whether it's school, coaching, chamber of commerce, whatever, the ability to show that it wasn't just the owner, but maybe there are 3 or 4 other people involved. A simple referral program is, like paying, if any employee gets a referral, or, you meet somebody, give them $25 if you sell the account. So they kind of have that presence, and it's a habit of establishing your brand in the community. So there's a lot of ways you can build bench strength. But what doesn't work is everybody's your age and ready to retire when you are. It'll be okay, but you're just not going to get premium value.
Yeah.
And then it's tough to get premium value, but we want to optimize your valuation. But
Yeah.
it's rare that every single box is checked.
So tell some war stories. And that's how we're going to end up this and wrap up this podcast. What are some of the most successful, easy deal where everybody win, the seller, the buyer, the consultants in the middle, the representation people in the middle win? And what are some of the deals that people cannot get out their own way? Like they just kill their own deals. You see both. So
when the owner has given a lot of thought to selling their agency, they didn't just wake up and say, I'm sick of this, I'm ready to go. But they had really kind of planned for a couple years that, okay, this is the year I'm going to do it. And then they actually pull the trigger. Those deals go a lot smoother because the seller has been mentally preparing, because it's emotional, it's personal, it's a project. It's not an insurmountable project, but it's going to take some time and effort to do it right. So the more deliberate those plans are, the better. And they have participated in a perpetuation class or perpetuation workshop, or they're familiar with best practices. They've done things to clean up their books and records, and they're just more prepared. They put some thought into it, and they've actually done stuff. The difficult ones are the ones that haven't thought much about it. Just, oh, I'll sell it when I'm ready to sell. And we've seen more of this, I think, the last couple of years, because the market's been hard, where owners are just worn out. They're just worn out.
so true.
The carriers, the remarketing, just the employee situations. Those are hard. Those are harder. Because it's probably going to be messier. Their financials are going to be messier. They're going to ask, well, why do you need this? Why do you need that? Why do you need that? They don't understand what goes into it, to being well prepared. The ones that get in their own way, that are sort of the ones that are, they underestimate the time and energy and what's needed to sell the agency. And they also, they second guess, and they just they think they know what they don't know. And they're just not, it's just difficult. They're probably going through that emotional preparedness at the same time because it's uncertain, and uncertainty, none of us like uncertainty. Most people don't like change. And you're talking about a massive change. And you're talking about, you got one time to do it right. So it's heavy on their minds. And if they haven't put the thought and effort into that for several months, it's harder.
What are the typical engagement from the first phone call in your experience of your customers, from the phone call to Kelly, introduce myself, to when deposit day, money in the bank? What is the time frame you used to seeing?
Well, part
If
of
you had to do an average.
the privilege of being in the industry over 30 years is I know a lot of my clients from a long time. So it's not just a cold call. But that said, I do work, I've had some that just are the, first date, let's sell, if they're really committed and serious, it's usually at best 6 months. And that is, it could go quicker, but people just don't move that fast. Life, they have vacations, they have Thanksgiving. People just don't move that fast. They're running their agency, and they still need to run their agency. So 6 months is keeping a pretty good pace. That's when a seller's like, okay, I'm ready. I've got the information. Tell me what you need and I'll send it to you. And they do within, a couple weeks. Sometimes it takes a year. Just they're slow. That life gets in the way. Somebody had a wedding, whatever. It's not uncommon. But I would say 6 to 8 months is very, very typical. 4 months is, I love 4 months is great. We can do it in 4 months, but that's asking a lot. Just that they really have to be on the ball.
When you say on the ball, are you talking about tax returns, P&Ls, all that stuff?
Books of business reports,
Yeah.
producer information. Yeah.
Book of business report can be pain in the butt to work with sometimes with some of the carrier that just take forever.
Yeah. It's just, yeah. And, we look at the book of business reports. I mean, we need, ideally, again, I want to get the best valuation. So we're obviously looking at premium and commission by line of business, premium and commission by carrier. I want to know producer schedule, who are the producers in the agency. And then I want to look at policies in force over the last 3 years so I can see that we can really paint a growth picture. Maybe we can't. And that's okay. I've had a client that deliberately was reducing policies in force. They were firing clients that needed to be fired. That client that you
sometimes you have to
times for the same information, or some really heavy servicing clients that just didn't fit with the long-term strategy. So policies in force declining is not always a bad thing if you're getting rid of the stuff that is a time suck. And so again, I want the better the data, the more information, then we'll get you that premium valuation. So if we're scrambling and we run into all kinds of situations. So but it, like I said, it's rare that there's the perfect agency that checks every single box. But I think what differentiates me and INS Capital is we take a lot more time with our clients. than some of the other sell-side advisors that just kind of stick everything into a template. We really drill down and find qualities to highlight and illustrate to the buyer. So you don't just look like another agency for sale, that there's something in there that makes it memorable, whether it's an industry niche, a demographic niche, some kind of training or incentive program, just things that we can really build on that make you memorable. Because the big buyers are looking at dozens of deals at any time. You know, and you can get the template acquisition offer, or you can get a premium offer. My goal is always to get you better than template, you know. So and not everybody, we spend more time.
One question I forgot to ask earlier, if you are also evaluating your buyer and they're going to give you 80-20 split, 80% cash, 20% equity shares of them, let's just say private equity, right? And you have multiple offers from different private equities. How do you pick? How do you judge them? How do you evaluate the buyer on the private equity side?
So that's a great question. And
what's important to you?
We have a matrix. I usually create a matrix where we can do side-by-side comparisons on what's important to you and the term sheets and the deals. And the details of that earnout that we talked about, is there an overhead allocation, whatever, what kind of producer development programs do they have? And we get into the qualitative stuff. Are they really going to help you grow? Or are you just another add-on with no real synergy and help? So it's not just the number, but it's a lot more than that we evaluate. Generally speaking, the earlier you are in the PE cycle, the more appreciation you're going to have on that stock element. But we do a lot of reverse due diligence for our sellers. Can this buyer deliver? I look at previous acquisitions. Who did they buy? I know a lot of agencies. And sometimes I pull up, the private equity buyer, the list of their press releases on who they've acquired. And my client may really want to be on that list and have those peers, or my client may not want to be in the same list as those peers. And there's no wrong answer. There's buyers for everything. So if it's it just depends on what that agency's niche is. If it's pure personal lines, low value, coverage A, whatever, that's not bad. That's great. But make sure you're going with a buyer that has something that really matches up with what, will help you grow. And the converse is true as well with, So, I look at who the buyer has acquired in the last couple of years, and chances are I'm going to know some of them.
Yeah.
Or I do some research on them.
Man, I'm going to send you an intake form. I'm not sure if I have done it or not. And Kelly, please fill it out. Allow our audience to find you, to follow you, to connect with you, and we're going to drop in the comment section. So thank you very much coming on the podcast. And
absolutely enjoyed it. I did fill the form out, so you should have that in your database.
Yeah, and we will drop that in the comment section. But thank you, and you are also always in the wealth of knowledge, and I'd love to have you again. Maybe we do a second half of 2025 where we can talk about the first half of 2025, the transactions and all that stuff.
One of my topics right now that I am really passionate about is unexpected perpetuation. And if you have a contingent buy sell agreement, and what happens if the owner dies or is incapacitated.
Hmm.
I have a lot to share on that.
Maybe we can connect
Yeah.
offline, and I got some ideas. I always thought that that itself is a fantastic business model, and I don't see like anybody really doing it and pushing out there. So we can have an offline conversation, but thank you for coming to the podcast. And I look forward to have you on again.
Okay. Thank you, Jeff. Take care.